the Fed for over a decade, their mantra has been getting the economy to 2% inflation. And that's always been their target. And so, inflation, like right now, it's all negative in the media about inflation. Oh, inflation's bad. The cost of everything's going up. And yeah, high inflation in some areas can be bad, but in other areas it's good. Moderate inflation is good because it signals a growing and healthy economy. So what we're seeing right now, some of the highest buckets for inflation: housing, cars, and specifically the used car market, oil and gas have been very high. But those primarily make up most of the inflation that we've seen. Food, that is very volatile. So we've at times seen inflation with food high, other times it's not. But one of the things that's been good with inflation is we've seen wages go up. So it's called wage-based inflation. So the cost of goods is going up, but people are making more money as well. And a lot of people have quit their jobs and gotten new jobs at a higher rate of pay this year. I had someone on my team who quit earlier this year and was able to get a higher rate of pay that I couldn't compete with, and so that kind of thing has been happening all over the economy. So those are good things because people are scaling up their career and earning more money. But with the inflation that we've seen, that's been a very different cycle because we haven't had this for 40 years. So that's one of the things that's been very different with the cycle that we're in right now. With the inflation that we've seen, mortgage rates are most closely tied to inflation. So, when we look at mortgage rates and how they're determined, basically, to just simplify it, when a mortgage is closed, it gets sold to one of several different government agencies, and then they package those loans and sell them to Wall Street. And then on Wall Street, they get traded as long-term bonds, and they're called mortgage-backed securities. And so because mortgages turn into long-term bonds, mortgages are most influenced by inflation. Because when you're investing in a bond, what happens is you pay a fixed amount of money up front for a guaranteed return over a specified period of time. So if the value of a dollar is going down, which is what happens when we have higher inflation, then you're going to want to earn more in interest income on that bond to compensate for the value of the dollar going down over that period of time. So the rate of interest that's got to be paid on that bond has to be higher. And so that's why we see interest rates on long-term securities like mortgages increase when we have high inflation. And so that's what we've been experiencing here. And a lot of the inflation that we've got, it can be tied back to some significant government spending over the last 3 years with COVID. And and I don't want to get too much into politics here with this whole thing, but we were passing out checks to people during COVID, almost just carte blanche with hardly any verification. People were getting a ton of money from the government. And when that much money is pumped into the economy, it's going to cause inflation. And so now we're starting to feel the effects of that at where we're at today.